Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off this week. Just me and Eric today. Let's get to the biggest stories right now in the nearly $14 trillion global ETF industry. And we start with the Fed speaks. Investors listen. We start to hear from various Fed presidents as officials discuss the historic rate cut and what comes after. Maybe AI can help you make sense of all that Fed speak. We'll dig into a new ETF that uses a chatbot investment committee that looks to mimic investor legends, such as Buffett, David Tepper, Stan Druckenmiller. We'll get into it. We'll also speak with First Trust about a relatively new ETF that tracks companies that are increasing R&D spending. All that and more coming up, but as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do we got?
Katie, thank you very much. And you're right, the market loves Fed cuts, right? No shocker. But what's interesting about the flows is equity ETFs had taken 3 weeks off. It was all bond ETFs getting flows ahead of that cut. But now people are coming back into equity ETFs big time, right? So look at SPY, 10 billion. That is an enormous amount of money. That's the trading crowd. And then VU, 9 billion. That's also absurd. VU is now 73 billion on the year. The old annual record is 50 billion. So it's 23 billion ahead of the record with 2 or 3 months to spare. Just unbelievable. VTI, the Qs, IEFA, that's international, and DFA fund there. Again, pretty bullish. Let's look at the outflows. A couple things on here that would be risk on that are seeing outflows. For example, XLF, TLT, some profit taking there, IVV, the Dow, HYG's junk bonds. But look how small the numbers are. These are all under $1 billion. Net, just a huge week in terms of equity ETFs. Speaking of that, I was kicking around on ETF Go, and I noticed that between the flows and the market jump, ETF assets are now at 9.8 trillion. So knocking on the door at 10 trillion. Actually, it rounds up to 9.9. We're almost there. I think we should have a party, Katie, when it hits 10 trillion. And what I want to point out, though, is that, interestingly, ETF assets double every 5 years since I've been covering the industry. And when they were at 5 trillion, I'm like, can they really make 10 and another 5? Well, they did. So you can see every 5 years they double. So we'll see if they can do it again, Katie. But again, huge milestone might be hit within the month.
All right, the dorkiest party ever, but we have to do it, a whisker away from $10 trillion. Eric, thank you. Let's keep the conversation going now with John Maier. He is JPMorgan Asset Management Chief ETF Strategist, joining us on set. John, it's great to see you.
Great seeing you. Thanks for having me.
So we're about a week out from that jumbo Fed cut that we got. Really surprising markets because it was a live meeting, 25 or 50, and we got 50. What's the script from here? When you think about ETF flows and past examples we have of rate cutting cycles, what do we typically see?
Yeah, first of all, the 50 basis point cut was a bit of a surprise, but some are saying actually that the Fed is behind the curve. So what I see with a 50 basis point cut, being that money market funds are about 5%, you want to extend duration at this point. There's $6.5 trillion in money market funds, and there's a lot of options in the fixed income market. So extending duration out, the jump out of money markets into, say, a longer duration instrument, I think that's the way to go, particularly active. And it's a great way to play this market.
And look, you used to be the model maker at Merrill, right? Second biggest ETF investor after the Bank of Japan chair. What are you thinking here? If you're making your model and you're thinking of where to go, do you want to go into fixed income, given there could be more cuts ahead? Or do you go into equities? How would you play that?
Well, first of all, like I said, there's $6.5 trillion in money markets, right? So you're going to step out. Some are going to go to fixed income, longer duration fixed income. Some are going to go to equities. On the fixed income side, you definitely want to step out a little further. You may not. You saw TLT. You mentioned has taken some profits there. People going out a little bit further on duration, I think, does make a lot of sense at this point to lock in some of these higher rates. We do expect at least another 25 or 50 basis point cut at the next meeting right after the election. So I think that's the right way to go.
And it's interesting. You think about some of the winners of this higher rate cycle that we've been in, these higher rates that we've been living with, north of 5%. Yep. Options income ETFs. Yeah. And I mean, JPMorgan really pioneered the growth of that category. You think about JEPI, how long was it going to take me to get to JEPI? But JEPI, obviously,
like 2 minutes, maybe?
A clear winner there. You think about now, we're on the other side. Rates are coming down. What is the outlook for some of those strategies that we've seen absolutely mushroom?
Well, you look at JEPI, it's yielding over 7%. You look at JEPQ, which is yielding in the 12% range. People love income, particularly if you look at the demographics. So I don't think you'll see outflows in those areas. And with rates declining, it's likely that investors are looking for alternative income. So I think that theme will continue to play out.
But, you know, JPY, which, by the way, is the biggest actively managed equity ETF.
It sure is.
They also have the biggest active bond ETF and the most active flows. So JPMorgan, to me, is really sort of leading the ground in the active renaissance. That said, JPY, in my opinion, has competition with the buffer ETFs. Because JPY's like, oh, we'll buffer your downturn with that equity premium, the covered call premium, but the buffers are like guaranteed no downside. How do you compete against that?
You know, first of all, JPY is designed to provide high income, but it writes 2% out of the money options. So there is the ability for some upside. So investors are looking for potential upside with JPY as well. You're cushioned on the downside to the extent you're receiving option premium. Also, remember, JPY is on a risk-adjusted basis. You're not looking to compete with the S&P 500. The risk is probably 35% less. So there's still a lot of interest in there, and there's a potential upside. And having the underlying portfolio being managed, I think, is the prudent way to go.
So normally in ETFs, there's the big blockbuster hit, and they try all these sequels, just like the movie business. And never does the sequel's always a little bit of a disappointment. But JEPQ has taken in $7 billion, right? That's more than double any other ETF you have. So you got the sequel coming up and is that because JEPQ gives you a little more juice on the upside, whereas JEPY was maybe a little disappointing with the upside the past couple of years?
Well, there's obviously a little more volatility associated with the NASDAQ or something that tracks something close to the NASDAQ. So a technology index or the underlying portfolio is going to be, you're going to get a little more juice because of volatility on the NASDAQ. So it also yields 12%, so you're being compensated for that extra amount of risk. Again, investors are looking, and they get addicted to that kind of yield.
Yeah.
And I think that's part of the success, combined with the prudent active management of the underlying portfolio.
Well, let's talk about sort of Frankenstein's monster here, because you have seen a lot of single stock ETFs launch that offer options, income, overlay strategies, and you get these really eye-popping yield numbers. And then, a lot of people, specifically on Twitter too, sort of say that that's not real. You're not really going to have that experience if you buy products like that. I mean, what is the JPMorgan view on some of the fringes that have launched off of maybe just an options overlay over an index tracking?
So I've been at JPMorgan 6 months, and I can tell you it is a conservative place.
Yeah.
And we're looking for, we just came out with the guide to ETFs, which talks about the ETF market. We're very much committed to the ETF market. It's obviously grown significantly. You guys mentioned it's about $10 trillion in assets, and we have grown significantly. We're a leader in education. We have guide to markets, guide to alts, and guide to retirement. Now we have guide to ETFs. And the only reason I bring that up is that we are looking to put our clients in prudent investments and build relationships over a long period of time. Some of the products you just talked about are a bit too volatile for particularly JPMorgan. So we're looking to be here for the long term, and some of those products may not be.
Well, you brought up the guide to ETFs, and I'm glad you did that, because I'm looking at a chart at page 18. I did not warn our producers I was going to look at this chart, but let me try to describe it. Basically, you have the average percent of options premium that you get with some of these products, and market-wide, that's about 10% or so. And this chart is interesting because you overlay it on the VIX, and that caught my eye because you have one of the criticisms of these products is that maybe they're artificially suppressing volatility. What's your take?
I don't think that's necessarily the case. I think these products actually take advantage of volatility. So volatility, I think volatility is your friend in a sense, because you're getting additional amount of income that you can pay out to investors. And volatility only lasts potentially for a short period of time. So we're taking advantage of that on writing options. But then the underlying portfolio is being managed bottoms up by a team of managers. And I think that's the difference with some of our products.
I remember, you at Global X, and you invented this term that I throw around sometimes, and it gets different reactions, conversational alpha. And people are like, what is that? Well, it's like when an advisor can tell a client about this cool new investment. That's what thematic ETFs do. Yep. What is the conversational alpha for you guys right now, talking to advisors? What value add are you giving them, and what are they giving to their clients?
Well, we are spending a lot of time focusing our efforts on the active space. And I was hired to create the guide to ETFs, which we launched 2 weeks ago, which the reception has been good. We are trying to create long-term relationships with our clients and provide them with great products and access to incredible managers. And so we are leveraging the deep bench that we have at JPMorgan and creating actively managed ETFs, whether it be in the equity or fixed income space. And I think that's really the value prop.
Let's go over this, because what I think you guys have done, I wrote a note that said that the way they pick the expense ratio, it's an art form with JPMorgan. You find that equilibrium between making decent money for yourself, but also bringing the fee down enough that it feels like a good deal. Like JPY, I think, is what, 31 or 35 basis points. How important is that? Because your mutual funds, you're almost like giving the institutional class pricing, but for everybody in the ETF. How important is that, and how hard is that to sell it internally?
Well, there's definitely a balancing act, and you can certainly externalize some of the costs with an ETF, and that's one of the advantages, one of the reasons you can bring down the cost as well. And I think that's very helpful, and it allows the end user to feel like they are still kind of getting ETF pricing, but access to institutional management. And sure, there's push and pull internally, but I think we find that happy medium.
All right, 2 quick comments. JPY, 35 basis points. You were right. You got it on the second time. Conversational Alpha would be a great podcast name, so something to noodle on. John, it's great to see you. Thank you so much.
Great being here.
That, of course, is John Maier from JPMorgan Asset Management. Now, coming up, a startup is launching a chatbot-powered ETF that promises to harness the brain power of the investment world's top minds, including Warren Buffett and David Tepper. Details next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with that big rate cut that we got from the Fed last week. You can see that showing up in the chart, specifically this one of EMLC. Of course, this is an ETF that tracks emerging market local debt. And you're taking a look at its total assets right now. And if you train your eyes over there, you can see that spike up after the Fed cut rates. This ETF now commanding $3 billion. Let's also take a look at another ETF that tracks investment-grade corporate bonds, because IGLB, it saw its biggest daily inflow since October 2020, after we got that Fed rate cut, of course, last week. So clearly traders placing their bets on the direction of markets from here. Let's switch gears, though. Let's talk about a planned ETF. It doesn't exist yet, but it's a new chatbot ETF. It promises to mimic investors such as Warren Buffett, David Tepper, Stanley Druckenmiller. The list goes on. Really interesting. The holdings, though, they may not necessarily reflect the real-life bets by those investors. So let's break it down now with the reporter that wrote the story. Her name is Vildana Heinrich. She's sitting to my left. So Vildana, give us an overview of how this might possibly work.
So the way it's supposed to work is there are 3 AIs that are asked to provide investments, provide potential companies for the ETF to actually be investing in. It's supposed to spit out a number of companies. They can range any geography and any sector. For example, it could, suggest something Latin American, and that means that those potential investments might not necessarily reflect something that Warren Buffett himself is buying or holding, but it's just something that the AIs are recommending based on data that's fed to them about Warren Buffett, about the things he says, the things he does, his letters, and that type of thing.
Let me correct myself. I was on vacation last week, so I'm a little rusty. It did launch, Eric. This ETF does exist.
Yeah, you're forgiven.
I'm sorry.
No worries.
I'm sorry.
Just this one.
I actually didn't know it launched either, to be honest with you, and I should know. Okay, this is kind of, to me, like a derivative of the whole 13F thing, where the ETF goes in and looks at the stocks that hedge funds say they own in 13Fs. There's been mixed results in that. I don't know. This almost seems like a little gimmicky, and I'm really liberal with giving ETFs the benefit of the doubt.
You
but
like hot sauce.
Do you really think that AI is going to be able to imitate Warren Buffett? Like, it just seems like, I don't know, like a little.
It's definitely one of the criticisms. And as somebody put it to me, you can just go and buy funds that are already run by some of these big names versus funds that are mimicking some of the big names. And when you look at the whole ETF lineup of AI-powered ETFs, so that can be ETFs that either are getting input from AI or ETFs that are tracking AI companies. I think those are the two broad categories that you can put it in. When we're looking at them year to date, they're not really getting inflows, and the performance is really, to compare to the S&P 500, only one of them is beating the S&P 500 so far. So, if you're thinking about AI recommending a ton of companies to you and you're switching up those investments a lot, that's one of the criticisms, because if you're switching up a lot, the thinking goes, all that turnover is actually going to hinder your performance.
And before I let you go, I'm curious about the list here. I named some of them: Warren Buffett, Druckenmiller, Tepper, et cetera. I mean, how did this team pick which investors they were going to mimic here?
I think they're just looking for some big names. As Eric said, maybe it's splash. It's people you would really recognize. It's a total of about 10 of them that they're looking to input. To their credit, to the company's credit, they say that they have had a lot of success in terms of beating the S&P 500. So they've been sort of playing with this and tinkering with it for more than a year now, and say they've had success. So we'll see how well this one does and how much it manages to attract cash.
Well, as we learned, this ETF has launched, so we'll continue to follow that one. Vildana, great to see you. That, of course, is Bloomberg's Vildana Heinrich. More ETF IQ next, but first, a reminder that you can listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld alongside Eric Balchunas from Bloomberg Intelligence. And it's time for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we're looking at RND, which is the First Trust Bloomberg R&D Leaders ETF. Full disclosure, Bloomberg is the index provider. The issuer is First Trust, though. So this is one of their, I would call it maybe a thematic or smart beta ETF. You can see here it's 60 basis points, just came out in May. $2 million. The idea here is pretty self-explanatory. It looks for companies that are increasing R&D for three consecutive years. It's sort of the inverse to that whole buyback craze. This is taking the money and putting back into R&D. Which companies do that? Let's look at that now. So on the holdings, you can see the companies that make the cut. And you got Meta at the top, Apple, Amazon, Microsoft. So you got a lot of these Mag 7, but then you got Eli Lilly, Philip Morris. This is important because these two stocks have been having great runs. And so look at the performance versus the Qs. I was shocked this thing was beating the Qs, to be honest with you. It also is beating XLK and the S&P. You can see here up 18% versus all those up 14. Why? Philip Morris, Eli Lilly. So going beyond the Qs and the Mag 7 has been the edge for this one. More performance like this, it should get some looks, Katie.
Eric, thank you. And joining us now to talk about this ETF, I'm pleased to say we have Ryan Issakainen. He is Senior Vice President and ETF Strategist over at First Trust. Great to have you on set with us.
Great to be with you. Thanks for having me.
So R&D, like Eric said, relatively new. Some impressive performance so far. And we're going to dig down deeper into those holdings. But let's talk about the investment strategy first.
Sure.
R&D spending, where investors are spending their money is increasingly on businesses that are spending money. But what is the sort of strategy that you were thinking about when you launched this?
Yeah, so as a growth investor, one of the challenges is not just looking back and seeing what has grown already, where earnings have been robust over the last trailing period, but you really want to predict what's going to come down the road. And we think there's a compelling link between the amount you're spending on R&D, the increase in spending on R&D, and the innovations that come from it, especially when you're dealing with mature companies. And if you look at the list that Eric was just referring to, these are all large companies. And so you want to make sure that these companies are not just large and mature, and instead of just paying out all their cash flows and dividends, if they've got R&D and they're increasing R&D, that means they see opportunities to grow in the future through innovation. And so we think that that makes a tremendous amount of sense, especially for those people that are looking for something, including the Mag 7, but beyond that as well.
And you look at the number of holdings, it's 51. So we have seen this trend of thematic and active ETFs with less and less holdings. We'll call it more concentrated.
That's right.
How important is that in an ETF like this? Is this something when you go to talk to an advisor, you're like, look, put a little bit of this on. It's like thematic hot sauce. If it pays off, it could pay off big. But you wouldn't want to go like all in.
Yeah, thematic hot sauce. I love the analogies. So I think being selective is important because the holdings that you referenced before, those did contribute to the performance, but also some of the things that we didn't own also contributed to the performance. And I think, for example, of some of the chip companies, Intel, for example. I mean, there is a link between how much research and development a company is doing and their innovation. NVIDIA has done a lot of research and development, and therefore they have tremendous products and tremendous pipeline. Some of the other companies that we haven't owned that have really benefited the fund, that we avoided because of that R&D requirement.
That is really interesting because, again, you take a look at the holdings and the top industry groups are internet, software, semiconductors. And you think about the narrative this last earnings season was that investors are getting a little bit frustrated with how much some of these tech companies are spending on AI without any results. But then you take a look at the performance of this fund and it's doing quite well.
It is doing quite well. And we think investors should be balanced and not going all in on just AI. We think there's all sorts of second order effects coming from AI, other opportunities to invest beyond those AI specific names. But yeah, those AI names are going to have a tremendous amount of revenue growth in the months ahead. So yeah, pay attention to what you're paying for those companies, obviously, but we think there's other opportunities as well.
Yeah, it's interesting. Somebody was talking about how AI is going to benefit some of the bigger firms. Unlike the internet, which a lot of small startups benefited from. Here you got the big guys, which you own most of, but I guess that's part of the R&D.
That's right. And again, I know we're drilling down on R&D specifically, but we think of other opportunities. A lot of people are talking about things like in modernizing the power grid and some of the investments that have to go alongside that. And there's other ETFs like GRID, GRID, that we're not highlighting today, but that is a great ETF for that specific investment thesis.
All right, Ryan, great stuff. Really great to speak with you. That, of course, is Ryan Issakainen from First Trust. And you can read all about this drill down, plus the latest news in the ETF industry if you subscribe to my weekly ETF IQ newsletter. But sadly, that does it for now for Bloomberg ETF IQ. I'm Katie Greifeld, along with Eric Balchunas, and this is Bloomberg.